Okay, testing 1, 2. Hello, hello, hello. See if anybody's out there, and then we can get going. Hopefully everything is good. Let's see. Market's okay. Everything looking all right. No pressure. No pressure, no pressure. Let's see. I have my tea. I have my tea. Can't do a webinar without tea. That's a known fact. Okay, people seem to be able to hear me. Okay. I started drinking matcha tea. Hang on, let me get the screen going. No one can see your screen. Click here. Okay. All right, let me know when you guys can see the screen. So I started because I went to Orlando. But I don't bring my teas with me. You know, I drink Ito-En kind of teas, and I have cases of them at home. There's like many, many different flavors. So I just have constantly drinking green teas. Anyway, so, you know, didn't bring it with me to Orlando, but in the supermarket, I saw these matcha green tea packets, and you just pour them into, you know, they're cold brew, so you can just pour them into water and shake it up, and then you got green tea. And I gotta tell you, I love it. And it saves money, and I love it. It's actually not if you get the individual packets, but if you actually buy like a little jar of matcha tea and you just take a little teeny spoon, it doesn't take very much, you put it in there, tea powder, and you shake it up, you get some really nice tea. But they only seem to do that with matcha tea. They doesn't say, I think it's a certain type of tea that dissolves easily. But I have to tell you, it's really great when you're in a hotel where basically, you know, you end up having like very boring water all the time. So I was very happy. I guess it's good on a plane. I mean, many uses where it's like, oh, because that way all you need to do is find some water and you're good. So if you're a tea person, I recommend it. No video yet? What are we doing, guys? Should be video by now. If not, I got a big problem. Let's see. People can see your screen. It says people can see my screen. I guess we can do just an audio. That'd be interesting, like a podcast. Oh, Albert has video. Okay, thanks, Albert. As long as somebody's got video. Holy cow, guys. All right, so let's get this doohickey started. Okay, Miss Robot, please.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, nor its affiliates, nor any of their respective officers, personnel, or representatives, agents or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OC website. Trade characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. So how is everybody doing today? We have a, this is not an update. I mean, basically, the Dow is up 1 point. The S&P is up 10 points. We're still at that 3780 line. Remember, that's the exact line we're supposed to be at for the week bounce. And I'm sure they're all at the same week bounce line, but you know, I just, you know, I guess I don't calculate every single one. I just calculate the ones that matter. NASDAQ is 11.6 something, and we're still under 17 on the Russell. None of this is good. The dollar isn't strong. We can't blame the dollar for this. Oil bounced off 101 to 105. I don't know what the right price for oil is now. The war screws everything up. You can't really make a big prediction based on the war. It was a holiday week, so I'm pretty sure there was no oil report today. Petroleum. Oh, come on, really? This is not enough of a hint for you, Google. Petroleum status. How many people? I guess lots of people ask about petroleum. So here's the petroleum status report. I'm sure this is still last week because it must be tomorrow the report. Oh, it said that, in fact. Weekly schedule, Thursday, June 23rd, blah, 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 tomorrow at 11. So this is last week's report. It doesn't mean anything. There was something I was going to show you, but I forgot now. Why did I want to look at this in the first place? Brain. Come on, brain. Oil. Oh, what the right amount of oil is. Yeah. Well, there's my constant bitch about this is how much are we exporting? We're exporting 4 million barrels. There is an oil shortage. Like no, look, not enough to justify what's going on. Last year, we had, at this time last year, we had 466 million barrels of oil, right? Now we have 418. Okay, yes, it's down 10%, more than 10%. But that doesn't justify oil going from 71 to 120. That's insane. We still have oil. We're not consuming more oil. And again, well, I'm not going to keep going over this, but you know, we are exporting because we're exporting 1.4 million more barrels per day. That's a lot. 10 million barrels a week. We're exporting 10 million more barrels per week than we were last year. 10 million barrels a week for 52 weeks is 500 million barrels. If we weren't exporting the extra 1.5 million barrels, we would have gone from 466 to 900. That's why I'm saying this is not a big deal. You got to put it in context. This number is here because this number went to here. It's a direct function, and it's not about the war, and it's not about OPEC, and it's not about the US production amount. It's a simple choice that we made. We had oil in the United States. We chose to send 10 million barrels a week, 500 million total barrels. What's the drop here? The drop here is from 9.1 to 1.7, 200 million barrels. So basically, had we not exported 500 million barrels, we would have gained 300 million barrels and we would be overflowing in storage. That is the only reason we have an oil problem in America. We're not affected by Russian oil. They never sent any to us in the first place. You know, it's not, and of course, obviously, if the word fungible, there's a cartoon for that doesn't explain what it is really, but the word fungible means that it doesn't matter whether or not we buy Russian oil because Russia doesn't sell to Europe, and Europe has to buy another barrel for, you know, Europe buys 1 million more barrels from, you know, from Abu Dhabi, and Abu Dhabi then sends 1 million less barrels to Cairo, and Cairo then, you know, or wherever, and then that country doesn't buy it from here and here and here, and then it's short. It's still short. You can't. It's so stupid to pretend that cutting off Russian oil does anything. Russia was laughing this morning. Putin was saying we're selling 40% more oil and stuff to China and these other countries. He goes, what do you think you've done to us? You haven't done anything to us, okay? They buy the oil from us instead of buying it from you. Now you're not selling the oil to them. It's ridiculous to say when you, it's not like saying we're not going to buy, we're not going to buy your brand of toilet paper anymore. It doesn't work that way. Unless we all stopped using the oil, unless we physically stopped or cut back 10% of our oil consumption and specifically said nobody on our team will buy Russian oil under any circumstances, then you might be able to cause some suffering to Russia, but you'd also cause collateral suffering to the other countries because, again, you're basically going to end up buying 10% less of everyone's oil, not just Russia's. It just doesn't work that way. It's a big, giant pool of oil that we all that comes out of the ground and is put on the world market, and the world takes it, and you never, to sit there and say this came from there and this came from there. Okay, it's like if they made air and put it up and just pumped it straight up into the sky. And by the time it gets to you, you'd be like, where is this air from? I want to know where this air is from. I'm not going to buy it if it came from Russia. It's freaking air. Breathe. That's what oil is like. That's what fungible means. It means it's going to, it goes into a pool on a global scale, and it gets used on a global scale, and you can't stop Russia from selling oil. That's the key to this thing. And that's why this isn't hurting them, these embargoes. That's why the ruble is so strong. It's like none of this is stopping Russia from doing anything. On the other hand, what's really stopping Russia, though, is they're losing this war in the Ukraine. I know you read a lot of shit from different sources, and I read a lot of shit from every source. As you know, I read a lot of stuff. I'd say that overall, Russia is losing this war. People are first of all, people want to say so because it sounds like you're picking David over Goliath, which you are. I mean, that's like saying I'll take the kid with the slingshot. It's not really it doesn't matter. It doesn't seem to matter much that he's got a slingshot. And that's what we're doing. We're taking the kid. We're taking the comedian. I thought this was funny because it's interesting. I just put up a post about Jon Stewart got the Mark Twain Prize at the Kennedy Center, and he was talking about politics and repression and so on and so forth. And I was thinking about the fact that like the hero of the world right now is this comedian Zelensky running Ukraine, doing a fantastic job because in times of crisis, it's the crisis that forges the leaders, not the other way around, or not, well, they don't forge, you know what I mean? But it's the crisis that creates these leaders, because you say to yourself, who are these people? How come people step up? How come you had, and there are some pictures today I was looking at from like a long time ago, and it was Churchill and Stalin and Roosevelt sitting together, the allies for World War II. There's a weird combination, right? Churchill's country used to oppress everybody on the planet, including America. Stalin, obviously psychopath, and and then Roosevelt, and they were hanging out. But you say like, why? What if you didn't have these people at that time? And the good news is that's what I'm saying. The times form the leaders, and it's like a diamond in the rough. Like somebody steps up, and in this particular case, Zelensky was forged in the fire of this war. I mean, he wasn't particularly competent as the leader of the Ukraine. He ran as a joke. He got elected, and he was running the country as best he could. He did his best, but he wasn't able to tamp down corruption or do any of the things he promised to do because it was too much, and he had no experience. But what he could do is lead, but because he had to, because he made a critical choice early on in the war to say, I live and die with my people in Kiev. He could have ran. He could have done a lot of other shit. He could have surrendered. But he said, we fight to the death and in Kiev, and I fight and I stand with my people. And he got right on the street and stood there with a gun and gave some great speeches and so on and so forth. And Putin, on the other hand, is his usual snide, sarcastic self, and he's in hiding and he doesn't come near people, and he's got cancer. It's like the end of every Russian leader. They're plotting against him, and eventually they'll pull the trigger, and he's gone. They're leading them into a war that doesn't go well is the last straw for these guys. You know, the generals and so on and so forth. Okay, they're willing to put up with a lot of shit as long as they get paid, but they're not willing to put up with being embarrassed like this. And this is an embarrassing war. It was poorly planned, poorly executed, and all they're doing is galvanizing resistance and pushing Russia further off the world stage, not bringing them onto it. At the end of this thing, Ukraine and Finland and probably Sweden are going to be in NATO, and it's a very bad situation for Russia, you know. But that doesn't mean it's not going to be a total disaster from now to then. Anyhow, so oil, fungible, so on and so forth. Like I said, okay, so bottom line though, this has got to be the thing that gets carried through. And I finally got people to start talking about it last week, and oil went down pretty quickly once people started pointing to this, because the traders know that this is the whole kit and caboodle. And when people finally started talking about this, after I published that picture with the frickin' circle, which I should have done a long time ago, because I realized it just, until you frickin' do that, until you make a cartoon out of something, nobody cares how many words you say. So I made a cartoon out of it last week, and I circled this number, and I said, this is bullshit. This is the whole thing right here. It's just math. 1.5 million barrels per week. More export. Not per week, per day. Okay, so that is, like the way it was 1.4 we were using. So that's 10 million barrels per week exported. 500 million barrels. Our entire stock of oil has been exported to other countries. And you sit there and look, and then you're going to use this statistic like it's in a vacuum. It's not in a vacuum. It doesn't indicate a trend. It's a trend we could reverse tomorrow and rebuild this 50 million barrel drawdown in 5 weeks. Not in 5 weeks. It's in 5 weeks if we just go back to last year's level. If we reverse this and put 28 million barrels back, if Biden tomorrow says no more exporting petroleum products, all of a sudden this number will be up 50 million in 2 weeks. We'll have oil coming out of our freaking eyeballs. They won't know where to put it. And you know what? That's how you beat these people, and that's how you stop this bullshit. And if I was advising Biden, I would advise Biden to short oil, do that. Step 1, short oil. Step 2, do that. And you make it financially horrifyingly painful for these people who are bullish on oil. All these people with all these contracts should lose billions and billions of dollars as oil crashes. And of course they just did anyway, just in this little fluctuation. But you know, just a lot, $10 drop, $15 drop in oil. But you do it on purpose, and you do it and say, we're the freaking United States government. We just made $200 billion shorting oil. You guys lost $200 billion being long on oil, and we will do this to you every time we see prices out of control. And then you will never see oil trade over $100 again. Because if the speculators won't buy it over 100, it'll never go over 100. And if they know that you're, rather than this bullshit where we're going to drain our strategic petroleum reserve, where's that? SPR. Oil in the SPR, 625 to 511, right? So we're going to drain our strategic petroleum reserve in a very futile attempt to shore this thing up. But that's only 100 million barrels. That only covers 10 weeks of the additional exports. It only covers 4 weeks of the total exports. It's got nothing to do with the SPR. It's got nothing to do with our current storage. It's got nothing to do with how much oil we're importing. We only import 2.8 million barrels. There's our imports. We import 2.8 million barrels, which again is less than last year. That's another thing. We're importing less oil than last year. I don't know what we're producing. Say what we're crude oil. The production is up. We're actually producing more. 15.7, 16.2. A little bit more oil is being produced. But well, I'm sorry, it's not being. I apologize. More oil is being produced total, but that's net of loss of exports. So U.S. production is up nicely actually. It's not about any of that. Everybody's arguing about the wrong thing. I mean, how much does it take to look at this thing and say, okay, what's causing a shortage of oil? Can we figure it out? What a freaking puzzler. It's right there. There is no question whatsoever that's what's causing the shortage of oil. And you can stop it immediately. So if I have my finger on that trigger, and I'm the president of the United States, and I tell the speculators that this is a weapon I am willing to use, that I will do this when I want to. I will put a cap on exports, or I will put a total cap on exports, or a partial cap on exports. I'll do whatever I feel like doing to make sure that we have plenty of oil in the US. And again, fungible. The 2 million or 4 million barrels of oil that we don't send out globally is 2 to 4% of global production. Okay, those guys can all sort it out. They'll buy it from someone else. Don't buy it from us. And who does this affect? Does it affect the refineries? No, it doesn't affect the refineries. They still make oil and they're still using all the oil. I mean, it obviously affects the whole oil sector because the prices would go back to normal and they wouldn't make as much money. But as Biden points out, they are making obscene amounts of money. Let's look at Exxon. Whoops. Okay, they made 23 billion last year. They're making 43 billion this year. That's one company. Okay, and I know we talk about we always a billion here, billion there. $20 billion. Okay, divided by 300 million people. $66 a person. But then you multiply that by, let's say they're 10% of all the oil profits. I doubt it, but let's just say it's 10. So that's $666. And essentially, what is that? There's your gas increase. That's how much more you're paying for gas, because we drive 15,000 miles a year, divided by 20 miles per gallon is 750 gallons, right? So if we're paying an extra $2 a gallon, we're paying $1,500 a year extra. Per car. But that money was for every man, woman, and child. So you have to think of it that way also, as per car. So if we assume that, it doesn't matter. I mean, you divide it by a small number. But bottom line, if you can see where the money is, okay? So there's Exxon, and it's everybody. It's not just Exxon. Here's Chevron. $31 billion. It's very nice and consistent, isn't it? Right? Valero, refiner. Wow, look at Valero. They were barely scratching it out last year. Now they're making $6 billion. Excellent. This is what they mean when they say windfall profit tax. Okay, a windfall profit tax is a perfectly realistic thing that that pulls back money when inadvertently government policies or war or catastrophes cause certain companies or certain sectors to make a ridiculous profit. Like if you change, if the government has a program that encourages housing and then builders make way more money and the government didn't anticipate that, they can call for a windfall profit tax to say you benefited from a government program, therefore we're going to put a special tax on. It's going to even it out a little bit, not take it all back, but just take some of it back. War profiteering is especially, though. It's like, if the government needed huge amounts of steel and iron and whatever for the war effort, and all these companies made a fortune, the government says, yeah, you made a lot of money, but how about, let's share the wealth a little bit. Let's put some towards war veterans or something like that, and take a little bit of this money and put it into the budget. So, this is why gas tax holiday is idiotic, because gas tax holiday only basically puts more money in their pocket, doesn't lower the price any. It makes it a little bit more affordable for people to go out and spend these ridiculous prices for gas. It doesn't change behavior. Now, there is a permanency bias. So this war in the Ukraine has only been going on since what, like February, right? So February, March, let's only count February. March, April, May, June. It's only June now, so 4 months. It's going to take more than 6 months before permanency bias starts forming and people begin to make decisions about their cars, let's say, based on the fact that they think gas prices are always going to be $5 a gallon. It's important to the oil companies to get oil back and gasoline back to $4 or less before that happens, because if people start thinking gasoline is $5, they will start making their forward car decisions and their fuel purchase decisions based on that. And once that happens, once you get people in that mindset, like think of your grandparents who went through the Depression and things like that, they never changed those habits, right? You're in the Depression, these people, and there was rationing in World War II. Our grandparents went through that too. So, whether they had the rationing in World War II or they went through the shortages in the Depression, those guys are like savers and collectors and whatever, and they've always got their certain habits that they have because they expect bad things to happen. They kind of always worry that tomorrow might not be as good as today. And lo and behold, they're right sometimes, right? In fact, that's one of the things going wrong with the market now is you have a lot of traders who have never seen a bear market. And you say, oh, we had the crash in 2008 and whatever, but it didn't last, did it? We had a crash in 2000. I don't know. Let's see if we can. Oh, Yahoo's been down. I don't even know if Yahoo's going to work. Let's see. Oh, no, they seem to be back. Oh, well, I guess it will. Oh, well, no, it's not really going to get back. So we had this crash in 2000, right? But it came right back. We had this crash here, came back not so quick, but it came back pretty quickly in 5 years. We had this crash, it came back right away, boom, boom, boom. So these people have never really been in a bear market. In other words, a bear market where putting money in is not rewarded within a couple of years. There's no point here where that doesn't really happen. Okay, you could be unlucky here and say, okay, well, I wasn't rewarded, but it does, you're talking about 2001, 2002, 2003, by 2004, it's back. Then you have a dip for a couple of years and it's back. That's not surviving a bear market, and this doesn't go back far enough for you to see all right, let's see what it does look like. S&P historical chart. La-di-da. Oh, come on. This got to be better. Why wouldn't you default to one that's really good? Isn't that weird? Or maybe the S&P just doesn't go back that far. S&P monthly chart. It doesn't really, this doesn't go back far either. Okay, let's say Dow. Here you go. Okay, well, I think, yeah. Now we're gonna make it super big if we can. La da da. No, it's still not long enough. Nope, nope, nope. I'm gonna try to get a chart that shows like the actual depression and stuff like that. 30 to 55. I don't want to do it that way. But okay, anyway. So in the 20s, 60, this breaks up into segments. It's all these different segments on this one. So I don't see any of these to do a better job. Okay, anyway, so in the 20s, you know, we were up here. The whole, in the 30s, down and down and down, stays down. This is 5 years of doom. Goes back up a little bit, but then 10 more years, doom. Takes all the way until World War II for the markets to start coming back up. All right, then you get normal, 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 then 55, and then you got the boom. Okay, and that boom comes up to here, but then you have this period also in the 60s and the 70s. So, you know, if you, here's your stock, right? If you put money in here, it's not really going anywhere at all for this whole period. Now, I'm not saying buying at 1100. I'm saying you buy 900. Basically, 900 is where you are. That's your range. For what is this? For 20, it's 20 years. That's, you don't really call it a bear market, extending the bear market be going down, but it's a going nowhere market all the way until 1982. I mean, that's a long time. Then we get into, this is what happened then. Well, this isn't even that. Damn it. This is very annoying. Nope, that one's not even resolving. All right, well then this is the best we're gonna get. So let me make this bigger. Oh, can't do that. Gotta pop it out there. Hope it's still readable. Click to make bigger. Processing request. Doesn't like it. Very sad. Nope. Doesn't like it. All right, let's see if we can just make this bigger. All right, so I'm sure you can't read this, so let's see. So this is what I'm talking about though. Here is, I wish I could tell you. Oh, okay, here's 1900. You're flat until, well, you're flat until, oh, I'm gonna kill somebody. So here's 1900. You're flat until the 20s. Then we have a big boom in the 20s. Then we go back, but then we're back to here. You're still in the same place as you were in 1900, okay? In 1940, after the Depression, you have an uptick in the Industrial Revolution. And this is 1896. 1896, the 1900s, early 1900s, we had obviously a very big change. So we went and doubled the economy or doubled the market from that period of time. Then it settled down. Then in the 20s, everything went crazy, which was very much like what we just went through now. But then you have a great big crash. And it gets worse. Even you're down at the bottom of where you were before you started, right? But then, now don't forget stimulus, right? Roosevelt comes in with his New Deal, and it's huge amounts of stimulus. Then you have the ultimate stimulus, which is World War II, right there. Oh, that's right. We had the World War I. Don't forget that. So over here is World War I. After World War I is when we started popping. And again, you had events that occurred that used up a huge amount of goods. The government spent a huge amount of money. We went into debt, so on and so forth. That's the kind of cycles you have. So then we go down here. Then World War I comes along. We have the economy's not, the consumer economy's flat. Like I said, shortages, right? You're struggling. You got shortages, but you're running a war. You're building and industrializing and so on and so forth. Then you come out of the war and happy. Massive, I mean massive growth in the Dow. Then it takes a rest. The rest goes from 1964, which we were just talking about, until 1984. You have a 20-year rest where the market doesn't do anything. Then 1982, what happened? Remember the Apple Macintosh commercial was 1984. So like to keep your mind set on where we were. But this is what I'm talking about. There are people now, most people, I'm old. I'm from 63. But people from 82, so I'm 60, so anybody who's 40 doesn't even know what a flat market really looks like, a bear market or a flat market. They think what we just went through is a flat market. They've known since 1982 nothing but gains in the market year after year after year. These people have no idea how to handle. They think this was a downturn. That's the point. That's a downturn. That is a downturn. This is not a downturn. This is not a downturn. This is a correction. This is a downturn. We haven't even broken the middle of the trend line. Okay, we're above average for this entire period of time, basically. Moving up and up and up and up and up. So, there was a downturn, huge economic growth. This is what our parents benefited from, right? Their whole lives, the market went up and up and up, and they were able to, retire. Well, our grandparents more so. Our grandparents who were adults in the 40s, they had some incredible prosperity during their time. Okay, then our parents raised us, or again, I'm assuming people around my age, but our parents raised us around here, and we went through incredible economic times, frankly. For our working lives, it's been incredible. And now we're heading into a little bit of a rough patch, but it's hard to remember what a rough patch actually looks like. It's hard to remember what people get upset about. But this is a rough patch. This is a rough patch. This is a rough patch. Not this. We didn't have a little freaking dip. We had a little interruption of our uptrend. It's not the same thing at all. And this only goes to 2010. So from 2010, I mean, this is Dow 10,000. We're at freaking 30,000 now. So you have to understand that the 2000, here's the 2000 downturn, here's the 2008 downturn. We're at freaking 30 now. This is where we are, but that's logarithmic, so you can't even tell. But here's 10, therefore 30 is way the frick up there. So, we're not even close to a bear market in the typical sense of the word. And people don't know how to trade this. And if we do enter a flat diminishing market and we do flatline for we could flatline for a decade. But that's probably not going to happen. That's probably not going to happen because we are still in the computer age. You know, we're still following Moore's law. Moore's law for computers. The number of transistors in an integrated circuit doubles every 2 years, and drops. I forget the number. There's a thing on money too, though. The images, but it's pretty linear. Yeah. You think things would not be so hard, but they are. Okay, so well, they're talking about how many devices there are, but that's a different concept. But you know, conceptually, this is what's happening in the world. Here's 2020. There were 1 million devices in 1982, which we were just talking about. I'm pretty sure it says 82. Really hard to read. Might be 92. Would that be 92? 92, 94, 96, 98, 2000. Yeah, because that's a 0. Okay, so it's 19. Even in 1992, that seems odd to me. Wow. So that seems pretty weird because how were there only 1 million devices? I sold computers in 1992. I would have. I guess it's because I sold computers. I thought there were so many more. So in 1992, there were 1 million devices in the world, and that's true. I did sell them for a shitload of money. But I mean, I had to question that because honestly, I think in 1984, the Macintosh came out, and I think the next year or even that year at Harvard, every single student was required to have one. So it just doesn't make any sense. I mean, you can't say that single schools were requiring 50,000 people to have these things, and there were only 1 million total. You know, not to mention obviously I had a computer in school. You know, and that was in the mid 80s. So I don't know what that means, but conceptually it is something like this. Okay, the idea is this has been the growth of computers and connecting things, and this is not slowing down. This is a whole growing, building world, and again, don't forget now, we're only just starting to put the computers in the cars, and I don't mean the little computers that run your engine and stuff like that. I mean computers in your cars that, like, your car now has a media player and a navigation system. It comes with the car. You don't buy it separately. You have media players, navigation systems, things like that, all in your car. You have satellites communicating with your car while it's in motion, sending you music. That's right there nuts. You got to realize how crazy that is, that we are all driving around. We are all driving around in cars that are getting their music services from space, and we just don't even think about it. So that you've got vacuum cleaners that have computers in them now. You're going to have all sorts of other things that have computers in it, including robots. Elon Musk is about to bullshit us with how ready his robot is, but we've got all this stuff coming out. So think about that aside. Think about that. Eventually there will be everybody who had a computer in the 80s and 90s when they were cool, right? Will have a robot in 20 years. And you'll have a robot that goes to the store for you and gets your groceries or does stuff and cleans your house and so on and so forth and hangs around and makes sure everything is done for you, runs errands, whatever it is you need. Be a robot. Not that complicated. What is it you want your robot to do? Clean the floor, do the cabinets, you know, like do the laundry. It's not complicated stuff. They're going to be able to do it. But there's chips and connectivity and so on and so forth, and will it displace workers? It'll displace workers, but also create incredible numbers of jobs and so on and so forth. So, and it's again a growth industry that doesn't even exist. It isn't part of the GDP yet. So we're not done yet. Now, after that, I think you're gonna hit a serious plateau phase unless we start colonizing other planets. But like I said, it's 20 years from now, so we got our whole lives still left to have some exciting growth opportunities. So this is probably a bump in the road where we're at now. We're having some inflation. Oh yeah, that was good on the Dow thing. That's one thing I wanted to talk about also. I forgot. See if we can go back to that. Aha. So when did we have our crazy inflation? We had our crazy inflation when Nixon took us off the gold standard in 1970 something. Gold window closed, 1971, there you go. So Nixon took us off the gold standard. That led to some massive, massive inflation. We had a flat decade of flatness. That was the last time we had that really. I mean, well, this is, you know, I guess this is flat from 98. You don't think of it that way, right? Because we had there was this giant rally, but from 98 when we peaked out in the market until basically here again, until 2008 when we crashed again, we had this very flat period here that we went through. But it's not a bear market because the bear market would have come back down here. This is a bear market and it doesn't recover, right? For years and years and years. This is a bear market here. It goes lower, it trends lower over a very long period of time. I guess, in fact, they're kind of windowed, aren't they, the bear markets? So bear market, bear market. They're calling this a bear market, but we know what happened. I mean, this is 2010. Okay, and now we're up here, like I said, now and up here is really 30,000 would be visually up here. But this is the last time we had massive inflation was in the 70s, 80s. But when we come out of that period, everything explodes up. You don't know when things are going to come off, but it doesn't destroy the world. And that's what we're being priced like now. We're being priced like the inflation will destroy the world. No, it'll flatten the markets. But we're so used to every single year, the markets go up and up and up and up that we don't even know how to deal with a flat market. And like I said, there are people who have absolutely no idea how to trade it and how to run it. That's why we're talking about things now where I say these companies, we're talking about companies and their growth and so on and so forth, like Crocs or whatever. And you say, well, how is Crocs a good deal? What if they, they're out of fashion? And it's like, I don't care if Crocs is out of fashion, or Hanes was another one that we talked about, Hanes underwear. So here's Crocs, and they're not out of fashion, that's beside the point. But 1 billion, 1.2, 1.4, 2.3, 3.5, 4. That's growth. These are annual numbers. Okay? The money, of course it's going to fluctuate, but 700, 650, 750. $750 million of earnings, and it's $3 billion for the company. That's 4 times $750 million. You're buying the company for a quarter for 4 times what it earns in a single year. That's 25% return on your investment annually. I don't care if they never grow again. As long as they keep doing that, I'm happy. All right. Will they pay it out as a dividend? Will it go into the cash of the company? It doesn't disappear when earnings like that, those earnings are then turned into something that will be realized at some point. And by the way, this is a mistake that happened to people back in the 90s, right? Before was it the 90s? Yeah, in the 80s and the 90s, what would happen is these companies that would be fat cash companies that had the old style mentality, they were the ones that became the takeover targets, right? Corporations would, raiders would come and go into the corporation. They'd be like, hey, Crocs, why are you sitting there on, not Crocs, they have debt, but you know, it could be reversed. Like if they do nothing and they pay off their debt, and that's why they expanded so much, by the way, they took on debt. But if they pay off their debt in 5 years, and then 5 years later they got $2.5 billion in the bank instead of that, and Apple was like this for a while, they had way too much cash, still have way too much cash. So then they become an attractive takeover target because they're like, wait a minute, you earn $750 million a year, you got $2 billion in the bank, and your market cap is $3 billion. So if I buy you for $3 billion, I get the cash back, $2 billion. So I bought you for $1 billion, and you make $250 million a year. That's what corporate rating was all about. You would go in and find cash-rich companies and cash flow-rich companies, and you would grab them and get them off the market. So believe me, these guys are on a screen. If it wasn't for their debt, they would have gotten bought already. This is an insane price. Okay, and their debt's serviceable and well in proportion to what they're making, so it's not really an issue. And then we were talking about Haynes, who has no debt, HBI. So companies, this is the thing, it used to be in fashion to have huge balance sheets, and then it got out of fashion because you made yourself a takeover target. You don't want to get taken over. Haynes is $3.5 billion. They make $600 million a year. Okay, so they're trading about they're trading 6 times earnings. They've got, oh no, they do have debt, sorry. So Haynes has debt also. They got $3 billion in debt. And again, that's why they're allowed, or not allowed, but that's why they end up getting to this level, because people are you know, nobody wants to take over and have $3 billion in debt sitting on their books all the time. But companies do that on purpose because they don't want to be taken over. They have to have something that's going to stop somebody from taking their company. As long as that's serviceable, it doesn't really concern me as far as that goes. So the point is, you know, when you're looking at a company that you want to have in a flat market or even a down market, as long as that company is making money, it's just like getting a return on your investment. This is 15% back on your money. 6 is 15% back on your money. 10 is 10% back on your money. That's what you want to be at. And by the way, that's why historically the PE of the S&P 500 has been 15%. 15% is basically 7 times earnings roughly, or 6.5. That's 6.5, and that makes sense, right? That's 6.5% interest on your money. That's competitive with what normal bond rates are going to be. So then you choose stock or bond, and you have to decide, you know, what are you, and that's why people say, oh, mix your portfolio, blah, blah, blah. They should be competitive returns. What's been going on for the last decade, effectively, has been bond prices have been driven artificially low, making them unattractive alternatives to stocks. Therefore, money has kept flowing into stocks, but the valuations of those stocks has gotten ridiculous to the point where at 30 times earnings, a stock is returning 3%. 40 times earnings, they're returning 2.5%. If the stock is returning 2.5% and it's risky, and a bond is returning 3% and it's technically not risky, although they are because they can lose their value too, then people are going to go into the bonds. That's what happens. Stocks and bonds compete for money. Everything competes for money. Everything competes for investing capital. It's all connected. Everything is connected. It's one thing that you have to understand, that if you take it from here, you put it there. If you put it here, you take it from there. So what the Fed is doing now is they're raising rates. Bonds go up. And the Fed has no choice, by the way. So Powell's like doing this thing today. And he's talking about all this bullshit. And you know, the Fed has to do this. We're doing that to control this and that. But the reality is, if the Fed did nothing, if the Fed sat there and did nothing, the bonds would still go up, because that's the global situation now, because inflation is a reality. The Fed can't stop inflation by standing still. And if the Fed does nothing and bonds go up because the bonds have to compete with inflationary dollars, right? If inflation is 10%, you don't want to put your money into a 30-year bond that pays 3%. The 30-year bond is sold in an auction. People will bid on it. They will bid the amount that they're willing to accept as a rate of return. If you think for the next 10 years inflation is going to stay at 10%, you are a moron for buying a bond that pays you 3%, right? Because here, I'll show you exactly how dumb you are. Let's see. Compound rate calculator. Yes, that's what it would be, I guess. And the one I like is Money Chimp. A good simple one. Okay, so $10,000 and 10 years and 3.3% for a 10-year note, and you get $13,800, right? But if the actual interest rate is 10%, that's $25,000, $26,000. So effectively, over the course of 10 years, if you're getting 3.3% and inflation goes up 10% every year for 10 years, you're losing half the value of your money in the bond. Even though you got this nice, whatever it was, even though you're getting almost $4,000 in interest, right, over the course of the bond at 3.3% or whatever, compounded interest. So even though you're getting a nice $4,000, you're like, oh, that's pretty snazzy, 40%. But the problem is, in reality, you need $15,000, $16,000 to keep up with inflation. So you're getting $4,000. You need $16,000. You're totally screwed. There's not a rational decision to buy a bond if you believe, and that's what it is. Now, of course, people buying bonds believe that inflation is somewhat transitory, that it won't last that many years. And yes, it's true, probably won't be 10 years of 10% inflation. That's kind of crazy. But there's a tricky balance, and the longer the inflation persists at 10%, and don't forget that, and that's why, by the way, you hear them, the government and the experts with big air quotes will keep telling you how, oh, we have inflation under control, and this report says that we've done this and now it's coming down and we see it improving, blah, blah. Of course they're going to say that, because the last thing they want you to do is panic, or not even panic, but just rationally make a decision that they don't have inflation under control, that prices are going to continue to go up, and therefore I want a frickin' raise of at least 10% from my boss, because I'm not going to get paid less in real wages than I got last year. And also, I'm not going to buy any frickin' bonds that pay me 3.3%. Where's my 8% bond? And then you go to your bank and you say, I'm not putting my money in a 2% save, a 2%. Good luck getting 2%. I'm not putting my money in a 2% account. I want a 5% account. Where's my toaster? Remember we used to get toasters? If you're my age, you know that, right? You got a toaster. You never got a microwave, because it was by that's a good cutoff, right? We used to get toasters for opening a savings account. But you never got a microwave, because by the time microwaves came out, which was the early 80s, by the time microwaves came out, that whole thing was done. Banks didn't give you shit anymore. So basically the cutoff was about 1980-ish when microwaves came out. But the bottom line is, they used to give you like a toaster. It wasn't a shitty toaster either. It was like a nice toaster. And that was the typical thing you'd get for opening up a savings account. I got a nice truck too, and I opened up a kid's savings account. They gave me a really nice toy truck. I was very happy about that. I had a whole scheme to like open up a bunch of bank accounts and get lots of toy trucks. We also used to get like 4%, 5% interest in our savings accounts. So it used to be like a serious thing. It's a joke now. I mean, I remember I had my little passbook thing, and it would show you how much more money accumulated every month. It was worth, but it was worth looking at. I did it with my kids. It was like I was like, oh, forget this. I'm like, it basically discourages you from saving when you see how little you get for saving. You get nothing. When I was a kid, putting the money in the bank and leaving it there was like, wow, look at that. I gained $10. You know, now I literally my kids are like, what is this? Like, will they pay you 8 cents interest? Anyway, so bottom line, all money is in competition, and the assets compete for the money. So your variables are what kind of return everything is getting. Then you also have to say how much money is there. That's the other thing the Fed is doing, right? They are reducing the amount of available capital. They do it by discouraging the banks from lending by playing with the overnight rates and the Fed funds rate and so on and so forth. So the banks don't make as much money lending. They tighten up their standards and put less money out there. The biggest money multiplier there is the Fed. The reserve rate the banks have to hold against money, right? If they only have to hold 10% reserve against their lending rates, that means if the Fed gives them $1 billion, they can lend 10 billion. And they only have to have 1 billion cash on hand to lend out $10 billion. So the Fed tightens the money supply that way by reducing the available capital that the banks are going to lend. That puts less money out in circulation, and in theory reduces inflation. If there's less money, then who's going to spend it? How do you spend it? And it's happening very quickly because you're seeing, look how fast the housing market collapsed. You can say collapse, but it wasn't that great in the first place. But the housing market contracted, and it should have contracted because it was only supported by the low rates. You take away the low rates, and then all these insane prices in the housing market can't be sustained. Because the houses aren't actually affordable. They're affordable because they were subsidized by such low interest rates that, again, oh, well, here you go. No, it's not really going to tell you. That would be a mortgage calculator. But, if you borrow $500,000 and it's 30-year mortgage at 2%, well, not 2%, we were 3%, let's say. All right, you're paying $1.2 million for the house in total payments, right? Or not really, though. The thing is, though, that you pay it down over time, so this money doesn't get to be that much. But comparatively, if it's 6%, $2.8 million. So keep that in mind. 3%, 1.2, 6%, 2.8. So however the reduction goes, well, that's a mortgage. Wait, okay, mortgage calculator. You need a mortgage calculator. Oh no. Just want to calculate it. Oh, all right. So $500,000, 30-year fixed. Interest rate. Wow, is that the interest rate now? 6.4. So there you go. Your monthly payment is $315. That means you're going to pay off your $500,000 loan in 30 years at 6%. All right. So if you're at 3, so it's 2.18 versus 6 is 3. So it's 50% more monthly payments at 6% interest. We go to 9%, and it's $4,000. It doubles. So what's the variable then? What if, and they are, rates are now 6.4%, the thing just said, right? So that's what the rates are now. you were looking for a house last year and you had, let's say your top was $2,500 a month, right? So now the reality is 6.4%. You didn't get your raise yet. You had $2,500 a month as a budget. The only thing you can do is find a $400,000 house. Is find a house that's 20% less money. It's your only choice. There's only a couple of variables here, right? So if people believe that their raises aren't going to keep up with inflation and all they can afford now is $2,500, they're only going to want a house that's $400,000, and they still want the same house they wanted last year. This is how housing prices come down. So they're going to offer less money for the same house. And they're not flexible. That makes them very good negotiators, right? They're not flexible because they just don't have the money. And they're going to say, take it or leave it to the sellers. And that's how the housing prices come down. I said this for a very long time. Housing prices will fall 20%. That's a correction in the housing market that needs to happen. And people are going to scream bloody murder and freak out about that. But you can't fix that. People don't have the money. The money does not exist. And people are not confident that they're going to have more money next year. Now, when I was a kid, we always got 10% raises. This is so in the 1980s in the 1980s, you expected to get a 10% raise every year. That was basically keeping up with inflation. So since I expected a 10% raise every year, if I could afford a $2,500 payment this year, next year I can afford a $2,750 payment, and the year after that I can afford a $3,000 payment. So I could stretch and buy a $3,000 payment house if I could figure out how to cover a couple of years until I got my raises. I was confident I was going to be making much more money in 2 years. It was like an almost certainty. And I'm not talking about switching jobs or whatever. I think even, like my father's age or something like that, he was going to get more money. That's every year you got a raise. That was how it worked. So when you go to buy a house, you say, oh, it's a little tight now, but in a couple of years, it'll seem like nothing. That's true. 2,500, 2,750, 3,000, 3,300, 3,600, 4,000. That's now 6 years. So after 6 years, you could afford 4,000. That makes your monthly payment. You guys have gone through this. I'm just trying to remind you. I mean, that was how we did the math. You're like, in 6 or 7 years, this will seem like a joke, this payment. Now, what we didn't realize at the time was property taxes would go out of control. That's another big thing in the housing market. The property taxes have gone insane. And I remember that was a big deal in California, even at the time. They had that Proposition 13 thing. That was their issue back in the days. But now what happened is the property taxes have now become as much as a mortgage for some people. You're talking about $1,000 a month for a $500,000 home in the Northeast. $1,000 per, not 1,000. I'm talking about 2,000 a month in a $400,000 or $500,000 home in the Northeast. It's almost as much as the mortgage. Now, if that's the case, now you can't afford any kind of home. So again, big correction coming. And the worst thing about the property taxes is they stole all your home appreciation value, the home, because people can't, again, it goes back to the same problem. You had this $500,000 home, you bought it back in 10 years ago, and now the property taxes are up 50% or double or whatever, and the rates are up, and now somebody's making you an offer that's less than what you paid for the home. Because the banks, through the higher rates and the government through the property taxes, have effectively stolen all the additional value of your home, because now your home is burdened with the taxes, just like companies that have borrowed a tremendous amount of money are burdened by the interest payments that they have to make. See, so it's all connected and all the same thing, but a lot, and that's why the Fed, though, it's so important, because there's so many of these levers are pulled by the rates that you have to really think about all the crap that cascades down from their actions. So let's see if we have any questions. I'll take a pause from my pontificating. Robin says, will someone please contact me and tell me what is going on with capital trading? Okay. Robin, that's something you got to go to Andy at PhilStockWorld.com and send a letter. Oh, you want to get a hold of Doug. I don't hear you say you can't get a hold of Doug. But I'm in the middle of this thing. I'm not going to be able to do anything about it. But send it to me. Send it to Phil at PhilStockWorld.com, and I'll get on it when I see it later. Robin said, if you use a bull call spread in a bull market, what do you use in a flat or bear market? That's different though. So that's the thing. You might want to sell more short puts. You might want to sell short puts, and you might want to run different strategies. We haven't run different strategies in a very long time, frankly. You can still use the spreads, but the spreads are more like the butterfly spreads, where we're aiming to sell a lot of short calls. But that's the problem. At this stage in a bearish market, at this stage, we don't know for sure that it's going to be a bear market. We can't tell definitely what's going to happen. In fact, what's happening right now? Nope. See, we're coming up nicely. Okay, good. But you got to think of the picture of the whole thing. Just hang on. Let's see. Is that the futures? That's not the futures. Here's the futures. That's the weekly chart. That goes back to this 2021. This is 2020. So going back to 2020, we are lower on the Dow. We are lower on the S&P, lower on the NASDAQ. That's from 2020. We're in a 2-year bear market for sure, right? So significantly lower on the Russell, almost a third down on the Russell. On a monthly, we're basically, all we're doing though is flattening the uptrend in the monthly. We're getting back on a track that makes sense. In fact, we're a bit below it, but still, we're in normal growth in these markets. If you're going back this is 5 years back. We're into a kind of more normal growth cycle, because you can't, again, this goes back to what I was saying about the bull market. This is not normal. This isn't supposed to happen. It's unsustainable. It's ridiculous. That's why I've been so pissed off about the valuations for so long. I couldn't justify buying at those levels. I can now justify buying all kinds of stuff. I love what's going on right now as far as like finding things for the portfolios. This is what we wait for. We wait for corrections like this to get excited about buying. Historically, what did we do? Okay, we had our member portfolios. In 2019 in November, we cashed out because I was thinking that the market was tremendously overvalued, especially going by the NASDAQ was really the one that was out of control, because the NASDAQ had gone from 5,000 in 2017 when Trump got elected to 9,000, getting close to 10,000. And I was fairly positive we'd be rejected at 10,000. If we got rejected at 10,000, we were going to come back to 9,000 for sure. That's a weak retrace. That's, in other words, you have a 5,000 point run. You hit 10,000, you're going to come back 1,000. That was like a certainty that was going to happen. So at the point of 9,000, I'm like, well, why should we hold these positions when we know that this is probably the best we're going to do for a while? Even if we creep up to 10,000, we're still going to come back. But I also was very worried about what was going to happen over Christmas. Plus, I was no, it was before COVID. It wasn't because of COVID that we cashed out. We just cashed out because it was just ridiculous. You know, we'd been running the portfolios for a couple of years. They were like they are now. They were up around over $2 million. And we said, screw this. This is too much. And we got out. And I'm basically, and this time, a lot of people requested that we not do that because they want to learn how to manage the downturn. I agreed to that. I wanted to cash out here. I wanted to cash out here because it was stupid. It's you know, it doesn't make sense to hold all these positions when you could be in cash and just watch this and have fun and just wait for things to come down. But we're doing it, and we're managing the short-term portfolio and using that for the hedges and so on and so forth. But the point is, historically, what did we do? We cashed out here, which turned out to be the perfect time to cash out. Then since we had cash we were waiting for first quarter earnings to see if we wanted to get out to get back in on stuff. We did buy some things here. In fact, the dividend portfolio, the thing about the dividend portfolio is that we filled it up because otherwise you're not going to make any money on dividends, right? So we filled it up early before the big crash of 2020, which started in like February, March. Before that crash, we kind of loaded up the dividend portfolio. That took a huge hit in the outset. We had to put more money into it and fix it, but now it's great because we bought more stock when it was down. The other portfolios, though, we were scaling them like we normally do and making small positions and so on and so forth. So it was perfect. Our entries were perfect, and that's why we have incredible amounts of profits now. Just timing. Timing is everything. You know, the other Robin was saying about the fund and so on and so forth. It depends when you put the money in. You know, when you put the money in at the top and it goes down, when you put the money in at the top and it goes down, you got to wait for it to come back. There's no magical way you're going to make it come back. And frankly, this is a time to put more money in when you bottom out. You don't withdraw and you don't go less. You have to then put more money to work and leverage the positions. Like the stuff that we're funding now is exciting. We were just looking. Crocs, you know, is 4 times earnings. Hanesbrand is 6 times earnings. You know, Hovnanian we did last week was 5 times earnings. You know, these are crazy, crazy low numbers that you get to invest in. And I don't care if the market doesn't like it, as long as they're making 20% back on my money every year. I can wait for the market to realize it's worth something. At some point in the future, as long as my companies keep making the money that I expect them to make, it doesn't matter that the market is out of favor. And we had this, and again, the key to this is what we talked about, and I just wrote this too, yesterday, right? I mean, I actually wrote it last week, but what did I say yesterday? That the worst case scenario, 2010, and I'd written it before. In fact, I referenced it somewhere. I don't know. I thought I referenced the other article. Oh well. I had originally written this earlier in 2009 when the market was crashed, and I wrote because people were freaking out. And I try this article. I encourage everybody to read this. This article does the math, and I explain. And there's more people. We have 8 billion people now. This is from 2009. We have 8 billion people. The global economy at the time was, I think, 60 trillion or 65 trillion. Now it's 90 trillion, 95 trillion roughly. So the GDP, the amount of people is up 30%, and the economy is up 50%, which means our standards of living as a global population have increased. All right, but what I said here is the average per capita GDP is 10,500. But the thing is that that's mostly like 6 billion people in the world, 2/3 of the people in the world, the bottom, not 2/3, 3/4 of the people, the bottom 80% of the people in the world don't make $10,500. Okay, oh, that's a good thing to look at. What is that? All right. Ugh. Oh my God. Okay. That's a crazy number. All right. In Afghanistan, the average person makes $500 a year. Algeria, 3,000. Albania, 5,000. Samoa, American, 12,000. Andorra, 40,000. Angola, 1,700 bucks. Argentina, 8,500 bucks. Armenia, 4,200 bucks. Aruba, 30,000. Australia, $50,000 a person. Austria, $50,000 a person. Azerbaijan, 4,000 a person. But you know what? There's more people in these poor countries than there are in these rich countries. Bahamas, 25, God bless. So you go to the Bahamas and you say, oh my God, these people are pretty poor. No, they're not. You want pretty poor, go to frickin' Eastern Europe and go to Africa and stuff and go to the Middle East. That's poor. Go to India. That's poor. The people in the Bahamas that you go, you know, when you're taking the bus to Atlantis and you go through that crappy neighborhood between the cruise ships and the hotel, those people are not poor. They have electricity and they have air conditioners and things like that. That's not what poor is. Bangladesh, there you go. Bangladesh, a lot of people, $1,900. They live on a $1,900 a year. They do everything that a human being needs to do to live for that kind of money. Belarus, Russia's best friend, 6,400 bucks. Belgium, 45. Barbados, those guys are much poorer than the Bahamas. Belize, 4,000 bucks. That's why people love going to Belize. It's so cheap there. Benin, Bermuda, they're kicking ass, $100,000 a person. They're kicking our ass. Bhutan, but that's, you know, that's pulled up like there's only like how many people are in Bermuda? Not many. Yeah, 63,000 people. There's only 63,000 people in the whole country, and you know, 50 of them are billionaires who reside in Bermuda. They throw up the whole thing. Bhutan, Bolivia, Botswana, Brazil, big modern country, a lot of poor people, but I mean, big modern country, $6,700 a person. British Virgin Islands, secret. I like that. Bulgaria, that's it. But I want to impress upon you that these are real places. Cambodia, Cameroon, Cambodia and Africa, same GDP, same per capita GDP. Canada, 43. Caymans, 85. Again, several rich people bring the whole thing up. Central African Republic, 500 bucks. Whole year, 10 bucks a week. That's it. 10 bucks a week. Why are we not tapping this labor pool? Okay, Chad, 659. Seriously, we can't seriously find some job that we can pay them 50 bucks a week for? We can't figure out a way to give these guys some money? Like, there must be something they could do that we could give them to do. The Channel Islands, that's Jersey, where I want to retire. Chile, China, great and powerful China, who make us quiver in fear and have all sorts of apocalyptic articles about, right? $10,000 a person. But that's the global average. Why? They're 1/4 of the globe. But there's so many people. Colombia, real country, nice country, lovely people, mostly farmers, 5,000 bucks. Congo, 544. I can't even imagine how that works. Costa Rica, 12,000. Cuba, 10,000. Also, lovely country. People are not, you know, I just went to Cuba. I was lucky enough to go to Cuba when they were open. I had to go. I was like, damn it, I'm going to go to Cuba. So I zoomed over there when they opened it up for a while. Had a lovely trip there. Happy people. You know, I mean, it's just they're generally a nice place. It's not noticeably poorer than Puerto Rico. So I'll say that about it. So I mean, I thought they were perfectly fine, and I was surprised actually. I really thought things would be worse there, but they just live a lower level lifestyle. That's all. Anyway, the point is, I'm sure been to some of these places, Egypt, okay? Egypt, $3,500. If you've been to Egypt, I mean, these are not people who are in abject poverty. They have a totally different lifestyle than we do. I don't even know what that is. What is this? I don't know what that place is. I don't know what that place is. It's a couple of places I don't know. Ethiopia is under 1,000. Fiji 5,000. Finland 48. That's okay. We like that. France, but French Polynesians get screwed, right? Gambia under 1,000. Ghana $2,200. That's funny because Ghana's kicking Gambia's ass because Greece 17. Greenland 50. Greenland 53. That's interesting, huh? Anyway, the point is, most of the people in the world live at much like 1/5 to 1/10 of the amount of money that we live on as an average in America. 1/5 to 1/10. We are bringing that average up. Canada's bringing that average up. Okay. Hong Kong, look at Hong Kong compared to China. Hong Kong's 46,000. That's why China hates Hong Kong. 46,000 compared to 10,000 for the average Chinese person. Haiti, Guinea. Yeah, you have to realize how much we have. Look at Ireland. Ireland's kicking ass, huh? Iceland. I remember Iceland came out well from the downturn actually last time. India, okay, billion people, $2,000 a year. 1 billion people live on $2,000 a year. So back to the article that we were talking about before I got sidetracked. So the global GDP. So the point is, there aren't that many of us. So if we all went down to the level, and again, think of the Bahamas or someplace like that where you've been. I mean, frankly, West Virginia is not too, some parts of West Virginia are not too different as far as economics. Certainly Mississippi, places in Mississippi, Alabama. There's certain alcoves in America that are basically as poor as anybody in those countries. But if you think of the Bahamas as a whole, places like that function at, oh shit, now I forgot the number. What do we say Bahamas is? 10, right? Oh no, Bahamas is 25. Bahamas is half of us. All right, but Belize or something like that. I don't know if less people go to Belize, but Belize is 5. Brazil. I don't know how many people go to Brazil. Bulgaria. I'm trying to think of places where people actually go where they have the good amount of poverty. Oh, Colombia. Well, again, I'm not sure how many. Costa Rica. These places. Hopefully, you guys have gone on vacation or something at some point. But anyway, so the thing is, you think of these countries, and the way you got to think about it is saying, okay, if everything got taken away from you tomorrow, everything, they kick you out of your house, you got no bank account, everything gets wiped out, okay? What are you going to do? And then you say, well, okay, I'm going to go find a job doing something. I will work at McDonald's at least. If you work at McDonald's, you're already getting paid $10 an hour is what? Like so 400 a week, 20, that's 20,000 a year. That's ridiculous. You're blowing these people out of the water. Okay. So as soon as you go to McDonald's and get a job, you are living the Bahamas lifestyle. You're as good as any, you're basically living at the Bahamas average per capita GDP. And again, when you see the average person, every country's like this, our country's like this too. Bill Gates is bringing our national average up tremendously, right? And in the Bahamas, they've got a few very rich people bring the thing up. The average people are in the much, probably, let's give them 2/3. I'd say the reality is for the bottom 80%, not the bottom 80%, but the middle class is probably living at a level that's more like 2/3 of what the per capita GDP is, because there are so many people with so much money that skew these results. That's very hard to figure out when you're looking at the polling. But conceptually, okay, you are going to have the lifestyle of at least somebody in the Bahamas. You're going to have some kind of job. You're going to go home and watch soccer on TV. You're going to have some kind of car. It might not be a great car, but you can have some kind of car. And boom, you're in the 25,000 club. You can't get to $10,000 in the U.S. Well, you can, but you're basically homeless. You're a homeless guy in a car with nothing. That's $10,000, and even then, how are you going to eat? So unless you check out completely, you're going to be at $10,000 to $20,000 in the U.S. So these guys can't go any lower, and frankly, they don't care. They don't have any money now. They have $0 in the bank. They have no savings for retirement. They have no money put aside. They have no possessions to sell. So they don't give a crap if it's not their economy, it's our economy. It's the economy of 2 billion people that we're worried about. Nobody in Bangladesh gives a shit whether or not Tesla's up today. Okay, nobody in Bangladesh cares how much you're paying for toothpaste. Okay, they're gonna buy what they can afford. That's what they're gonna do, and they're gonna wake up and do whatever they need to do to get food and shelter tomorrow. So their GDP will not change. Almost all these small countries, they're the small GDP countries. Once you're below $10,000, that's basically where you are. So when the global GDP averages, and why is global GDP average then $10,000? That's because for the poor people, if you take out all the billionaires, you're not going to. It's not that many to bring the average up of, because you've got 8 billion people who are poor compared to the there's 2,500, maybe there's 3,000 billionaires total on the planet. So they're bringing things way up on a per capita, right? So they bring the per capita hugely up. Obviously, then there's another 30,000 people below them in the top 1/10 of 1%. They've all got 100 million plus. But then there's another 300,000 people below them in the top 1%. But still, you're only talking about like 400,000 total people in the entire planet who make millions of dollars. And if you distribute that among the other 8 billion people, it doesn't make much of a dent in their budgets. It doesn't, but that's how much it brings it up. So if we say, let's say 400,000 people have, let's say $20 million each. That's 8 trillion. That's probably about right. So they have $8 trillion, but 8 trillion, oh, I'm sorry, so 8 trillion divided by 8 billion other people is what? It's only $1,000 a person, right? So they're not heavily affecting the average. Even if the top 1% has $20 million each on the average, they're only bringing the total for the world up by $1,000 a person. All right, but of course, if you ask this guy in Afghanistan whether he'd like that $1,000, I think he'd probably say yeah, right? But anyway, so that means that the unaltered average per capita GDP, instead of being $50,000, is $40,000 for the average person, right? And then even so, our top 2 billion that live in these 25,000 plus countries, in $25,000 plus countries, we bring the total average up by, let's say we average $45,000. We're only bringing it up, it'd be 45,000. It's the difference between 10,000. It's the difference of $35,000 divided by the 3/4. That's so it's gonna be $35,000 times 2 billion people is 70 billion people. So it brings it up 10. It brings up 10,000. So that's not even the right number. Because the average is the global GDP, the global average is 10,000 something dollars. So we're bringing it up by a substantial amount. That's what that's telling. So whatever the number is, we're bringing it up by a pretty substantial amount. So the reality is, for the 6 billion people below us who are not in our modern civilization, and I'm talking about setting the level at the Bahamas as the baseline, but there are 6 billion people living far, far, far below that. So far that we can't even, no matter how much money we have, it doesn't improve their situation. But on the other hand, on the bright side, if we all go if we all go back to 10,000, we're going to have no real effect on those people's lives. So then we're going to have 8 billion people. And what do we say? If we take out the billionaires, it's 9,000, right? And let's say if we take out us, it's another $1,000 off their lot. So let's say it's 8,000. So if you say $8,000 times 8 billion people, that's is $64 trillion. So the global GDP is currently $94 trillion. If we have nothing, and we have to get up and sell beads on the sidewalk to make money, I don't want to denigrate the Bahamas. I mean, they got people who have real jobs. There's electricians, there's phone guys, and whatever. But I'm just saying, you see people in the poor areas, or the tourist areas anyway, they're braiding people's hair and doing beads on the sidewalk or whatever. If we all just, whatever crap you have to do to survive, you're still going to generate $8,000 worth of GDP at least. And obviously, you couldn't possibly live on that. You will do whatever it takes to generate $25,000 in GDP. You will sweep the frickin' floors at McDonald's. So whatever it takes, that's where we're going to be. So therefore, when you see global companies dropping 30% from where they are, that's this level. That is the level of the entire first world being wiped out and placed into abject poverty. That's what it means when the market drops by a third. That's why I feel confident when I'm investing at this level. When the market drops by a third, and again, it's not a third. Where's that? Okay. So that's basically the gist of what this article is explaining, okay? You still want to get a Coke. You still want to go to McDonald's. You still want to eat at a grocery store. So when the markets drop this much, you've got to take that step back and say, this is not realistic. Just like this is not sustainable, this is not sustainable. You can't, this is sustainable, but this is realistically not going to get much worse. Because what you're doing is you're saying, and again, not every company, there's still plenty of overpriced companies. Amazon still trades at 100 times earnings. Netflix still trades, no, not Netflix, I'm sorry, but Amazon for sure. Tesla, obviously 100 times earnings. There's still plenty of companies and plenty of companies with unbelievable valuations. So can the market go lower? Absolutely. Because Amazon, one of the biggest companies on the planet, $1.1 trillion, 60 times valuation. What if they traded at 20 times valuation? Then they'd be $300 billion. Then they would lose then they'd lose $800 billion in market cap. And what about Tesla? Tesla already took a hit. 700, right? They're trading at 50 times earnings. So if they traded at 20 times earnings, they'd lose 400 in market cap. So right there, just Amazon and Tesla, if they went down to 20 times earnings, if people said, you know what, you're not going to grow this crazy and we're not going to pay for it, there's $1.1 trillion knocked off. But I will tell you now that That's already happened to many companies. That's already happened to many companies. And that's why we're looking at such attractive investment opportunities. Because for many of these companies, like I said, there's companies now trading 4 or 5 times earnings. That's reflecting that the global GDP is going to drop 50%. I mean, if inflation is 10%, then your PE should be 10. Basically, if inflation is 10%, you as a company have got to be dropping 10% to the bottom line of your market cap. Otherwise, I've got better places to put my money. Not yet, we don't. But when bonds catch up to inflation and are paying 7%, 8%, I put my money in a bond and take 8%, especially if I can get 8% for 30 years. I'll take 8% for 30 years. That's a shitload of money. And you just got to hope that inflation doesn't go to 100% and wipe it out. But, you know, anybody who got 8% for 30 years, you know, would have been very happy in their retirement going back. So, you know, there are plenty of bargains, but you just have to say, what's the worst thing that can happen? And like I said in that article, the worst thing that can happen is this. And that's not happening anyway. But there is a bottom. There is a base to the global GDP. It's going to be about 65. It's not even 65, but really, like I said, unless we're completely wiped out, it's going to be higher than $65 trillion for GDP. It's going to be probably 80 at least. And 80 at least is only 20% off the top. And that means S&P 500 companies who operate globally, like Coca-Cola, are not going to drop much more than 20% off the top. It's not realistic to expect that. McDonald's, not more than 20% off the top. Things are going on right now. There's a war, there's interruption in this, there's a supply chain issue, so on and so forth. Those are temporary. You don't invest for what's going on this minute, you invest for the long term. So long term, unless we go nuclear and the war wipes out first world civilizations, we're not going to be as bad as the markets are currently predicting. And you can say we're going to have a recession and then we'll go down and the economy will shrink 5%. Yeah, that's what you're predicting. That's what these numbers are predicting now. Tell me something worse. We just said that we're planning on the GDP going from 95% to 80% or less. That's a 20% reduction. Obviously, you have to have a recession to get there. See, that's the thing. They want you to be shocked and then shocked again and then shocked again, but it's just the same news being repackaged, okay? We're having the recession because rates are going up. We're having the war. We're having the supply chain issues. They're all things that are happening. But yeah, that's causing the recession. You can't say that things are going to get bad because of the supply chain issues and then say, and you're going to have a recession on top of that. It's not on top of that. That's why we're having the recession. The recession is a measurement of the impact of the supply chain issues and the war and everything else. It's not another thing that's happening to us. And that's the problem. That's what's going on. Is lately, especially the last couple of weeks, all these banks have been coming out saying, you're going to have a recession, 50% chance, 80% chance, 75% chance, recession, recession, recession. Of course we're going to have a recession. We're going to have a recession because 25% of our GDP in the last 2 years has been stimulus. And yes, we had a virus. We shut down the economy. People stayed inside. That caused the economy to shrink drastically, but we papered over that with $10 trillion or $20 trillion worth of, wait, 10 or 20? 10. $10 trillion in stimulus over 2 years. It's actually 11. So we took out $22 trillion GDP and we put $11 trillion into it over 2 years. It's 25% of our total GDP of the $44 trillion 2-year GDP. And that's how we kept the economy out of a recession. Now we're saying, oh dear, we're $32 trillion in debt, so we probably should stop putting $5 trillion a year into the economy. Now, the economy which was down, obviously was down because we had no net GDP growth, did we? So since the economy was down to net of stimulus, $17 trillion, right? If you take out the stimulus, $17 trillion economy, drastically down. Everybody would have freaked out if they saw those numbers. But now we're open again, and we're not going to see 17 trillion, but we might see 20 trillion without the stimulus. We're going to see 20 trillion. We are still down from where we were. And that means we're going to have 10% negative GDP growth, a recession. It's all just the same thing, though. It's all the same story. This is happening because that happened. It already happened. It's not something you should fear going forward. It's just the measuring tool that tells you what happened. So when people tell you that, IBM dropped whatever, faster on. So, when people tell you, well, IBM didn't drop because it's so soft. Let's find a better example. That's kind of funny. Let's say Target. Okay, Target's a good one. Okay, so Target. So when people tell you Target fell from 250, 260 to 140, they fell 50%. 50 freaking percent. Okay, and yes, earnings contracted. First, they went up. They had a really good year in 2022, but that's just stimulus jamming it up. Normal earnings, 3.2, 4.3. If you ignore this and say they went from 4.3, 4.1, then back to 5.4, this is pretty normal good growth. And the bottom line is 5.4, and you're buying the thing for 67. So then we take 67 divided by 5.4. 12.4 times earnings. That's good. But just because this chart looks ugly, you can't listen to people who tell you, "Oh, it's going to 100 because look at this pattern and look at that and blah blah blah." Why? Why would it go to 100? Why would Target drop to $45 billion? Why would it drop to $45 billion when they make $4 billion a year? Why is Target going to go to 10 times earnings? And if it does go to 10 times earnings, how much can I buy? Is there a limit? What can I do to get more Target at 10 times their earnings? Because if there's inflation, then this number goes up and this number goes up. And the dollars may not buy you as much, but on the stock market, it's going to look great. But when there's inflation, even though, inflation at first may cost Target some money, like goods may increase in prices and so on and so forth, and they can't pass those prices on to consumers quickly enough. In fact, that's what this whole inventory adjustment thing they did is they had the wrong kind of goods. They had paid too much money at the top, because they ordered these goods. Don't believe we have the bottleneck of supply, right? So Target orders, and when they say they have the wrong kind of goods, Target ordered last June, Target ordered 100,000 Christmas decorations, right? And you know what? They didn't arrive in Christmas. They arrived in March. They just arrived this March. They didn't make it in Christmas because everything was backed up shipping and all that crap. So in December, Target had very little Christmas decorations. Most of it hadn't arrived. In March, the Christmas decorations come in. Those Christmas decorations are expensive. Target does research and says, you know what? Our clients aren't going to buy these decorations. So what they'll adjust their inventory. They'll make deals with the manufacturers. They'll get some stuff will get put in the store discounted, but some stuff gets sold to big lots. And they say, look, this is it's old. It says the wrong thing. It's out of fashion. People don't want these now. Now it's too expensive for people's budget. Everybody wants to spend less money for Christmas, so nobody wants to buy the $45 Christmas lights. whatever the reasoning is, Target knows their customer base, and so they did an inventory write-down, as any retailer should when they have a mismatch of inventory to demand. And now, given the situation and knowing that the shipping is late, they are now adjusting everything about their operation to properly get things in at the time that they need it. But a lot of people, I mean, a lot of retail got caught with their pants down because of things that were, things change, situations change, numbers change. But that doesn't mean they're doomed. It just means they have to adjust and adapt with the times. So we invest in good companies with good management teams with solid balance sheets that are going to make it going forward. And that's the kind of stuff we're looking for right now in the portfolios. We're going to do this now and bring these companies to the forefront. It's an incredible opportunity to invest in these companies, in solid American top shelf blue chip companies at bargain prices. Not everyone is on sale, but as a guidepost. And again, I don't want to make it like just look at the PE ratio, because you got to understand the whole picture and how much debt they got and so on and so forth. Target's got $13 billion in debt. They make $4 billion a year. It's payable, but you have to add 3% to this debt. All right, so that's going to be let's say half $1 billion. I mean, it's a lot of money, right? Am I overdoing that? 13. 356 times 0.03, 400 million. Yeah, 400. So you have to take $400 million and knock it off here. So actually, this number is going to be 10. Well, this number will be 10% less than it says, because they're not accounting. And I'm saying that not for a fact, but generally, companies are not accounting for the rising rates. They're not accounting for it in their profit projections yet, because again, they don't believe it's there. You're not for sure going to see it in so on and so forth. But as the Fed keeps going the way they're going, the companies are going to start dropping their forward projections. And again, they're not dropping their forward projections because they can't sell anything. They're dropping their forward projections because their cost of interest, their cost of capital is increased. And that is a long-term thing that they will then down the road adjust their prices for, and their prices will go up and it'll match out. They'll go back to normal. Most companies are bottom line centric, and most companies will adjust these numbers. They'll adjust their top line, they'll adjust their spending until they arrive at the correct profit ratios. That's why, I mean, anybody who's worked in a company knows this. The companies go through cost-cutting measures. They'll go through, they promote sales, they raise prices, they do this and that. Whatever it takes over time, they will get back to normal, and they'll get back to their average rate of return, which for Target is roughly 5%. Look at it. I mean, look, 5%, right? 5%. It's very simple. 5%. That's what they expect to make. 5%. 5%. That's what Target makes. Okay. Are they making 5%? No, they're a little below 5% this year. Next year, they're going to get back closer to 5% because they're going to make those adjustments. They plan to make the adjustments to get their net profit back to 5%. That's where they want to be. But the good news for them is that if inflation is 10% and people keep buying, then this goes from 110 to 120 to 130, 140, 150. And as long as they keep that 5% going, 150 times 5% is 750. So you will look like a genius for buying Target when it was making $5 billion, because they'll make $7.5 billion based on inflation in 5 years. And they'll still command, the earnings ratios won't change. They'll still get 12 times earnings, 13 times earnings, but it's going to be 12 or 13 times 750. So it's 750 times 12 is $90 billion. They're at 67 now. You got to have the bigger picture though, and you can't get sucked into this bullshit about, what's happening today and what's the Fed doing now and what's Powell saying and how it's bullshit. And again, it's that thing where it's double counting everything. Because the Fed raised rates, the cost of capital went up. because the Fed raised rates, we have inflation because it's anticipating higher interest rates and so on and so forth, and a less availability of capital. We have the war, we have the supply chain, we have the oil, which is a huge part of inflation also, the oil. So there's all these different factors causing it, and that ends up causing a recession. That causes the economy to contract. The recession is not another thing to worry about. It's the thing that we have because of all the other stuff. And you see the reaction where people say there's going to be recession. Oh my God, there's going to be recession. There's going to be recession because math says there's going to be recession. Because these things have happened, the economy will show contraction, and therefore we will be in a recession. We're in a recession now. It just hasn't been measured yet. That's no reason to panic out of a thing. And this is what Buffett teaches you. This is what Jeremy Grantham teaches you. If you read the books, you've got to understand that bigger picture. You got to look at the broad perspective. And you have to understand that these companies, not Target, but other companies like Macy's, has been there since 1890. They've gone through this. They've been through the Depression, the Recession, World War I, World War II, blah, blah, blah. They've been through Nixon's inflation. They've been through the gold standard being taken away. They've been through the Arab oil embargo of 1973. All right, but when you go back and you say, oh my God, look at all the shit they survived. Well, again, look at what these people survived. They've gone through this over their history. This is just another one of those things, and these companies will survive. But again, be smart. Don't pick the companies that are overpriced. Don't pick the companies that that will not be able to pass prices on to their customers. Coca-Cola, McDonald's, Boeing, Alcoa. They'll pass along the price. There are things that people need and things that people don't. And not everybody gets to raise prices whenever they want. And that's the debate we're having about Netflix, is whether or not they can pass along their prices. I mean, can they pass another cost increase along? Seems like a terrible time to do it. And what Netflix does instead is they're trying to get people to cut back on sharing. Because in theory, if less people share, then some of those people who are sharing, and I agree with Netflix, by the way, that I don't agree with the way they're doing it, but in theory, like on my Netflix, there's 5 people on the thing for the login. But it's my family, but they don't all live together. My kids are in college. Technically, they shouldn't be on it. So Netflix wants me to capitulate and pay an extra $2 to share. I will, because my kids would freak out if I took away their Netflix, if they had to start paying for it. There's a lot of things like that, but this is what happens during inflation, and it doesn't happen overnight, and we're not giving it any time. We're all acting like everything has to be fixed tomorrow. But it takes a long time. Netflix is trying this and trying that and seeing what works. And the first thing they're trying to do, which they think is low-hanging fruit, is they're saying, they're going to cut back on sharing. I haven't seen anything that they've done to indicate that they're actually doing this. They just say they're doing it. But at some point, I guess they're probably going to pull the trigger and start flashing warnings on your screen or something like that. But the point is, they're trying to just shake out, and if they can, they're not going to lose anybody. Like, I'm not going to turn off Netflix because they told me my daughters have to pay $2. I might tell my daughters to go pay, get their own account, or tell them they got to pay the $2, something like that. Obviously, I'll end up paying it, but I don't think people are going to cancel their Netflix over the fact that Netflix says, you know what, this is for your house. It's not for everybody. It's like when cable. Remember there's a time when everybody was stealing cable? Because nobody, it was $20 a month when it first started, like 1980s, and it was $20 a month, and people were like, screw that, $20 a month for TV. TV's free. And it took a while, but these days nobody steals cable. Everybody pays what they pay for their cable. In fact, that's gotten to be an insane cost these days, with the internet and all that. So, Netflix is hoping that 10% of the people who watch it for free start paying for it. And if they start paying for it and Netflix makes 10% more money, they're going to be thrilled. Because it doesn't cost them any more money to service it. They're broadcasting the same movie to the same people they were broadcasting last year. Now those people are paying. And not only that, but the people who say I won't pay it, screw Netflix, how does it hurt them? As long as I don't cancel, they don't care if my daughter stops watching. They still have me as a subscriber. It's less load on their network not to have my daughters watch. So, companies think about it, have meetings, have votes, determine, they try something, they see how it goes, they have more meetings, so on and so forth. None of this has been given a chance to happen. But eventually they work through and model the inflation and build it into their future. Whatever it is, they build it into their future. And nobody is giving it a chance, and people are panicking as if this is the end of the world. But it's not. The world goes on, and things will adjust, and some people are going to make it out smelling like roses and some won't. And the best way to go, though, is to concentrate on good, solid, blue chip companies that we feel are going to be able to move through this. All right, so that's my day. That's my lecture on inflation and so on and so forth. Couple of questions, and then we'll get going. Mark says apartment prices are insane. Yes, apartments are completely out of control, but you have to realize the pressure on the landlords. Taxes are going up, interest is going up if they have various loans and so on and so forth that they have to pay back. Some of them may be adjustable. Utility costs are going up. There's all sorts of things happening. Insurance costs going up. Everything goes up. So how do you expect them? If the apartment was $2,200 last year, and they raise it 10%, now it's 2420 or whatever. And if they do it over 2 years, it's 2,600. They're just passing on the 10% cost that it costs them. Not all these landlords are evil. I will say, well, the biggest problem in apartments, and again, I can go off on a whole tangent on this, but the biggest problem in apartments is these frickin' venture capital firms. Okay, it used to be here. That's the problem. The venture capital firms are taking apartments. So if you had a guy who had a building, a landlord has a building, he's got 20 units, and he's had it. He got it from his mother. He's had it from his mother, and his parents passed it down to him, and he owns the building outright, and he's been collecting the rent. And he makes a really nice living, collecting rent and so on and so forth, and taking care of the building. He's clearing a couple $100,000 a year. Great. Okay. And the rents are $1,500 a month. So a venture capital company, and this is being done on a massive nationwide scale right now, venture capital companies are running him in a database. He gets flagged because he could be raising his rates substantially in this market and making much more money. So they go to this guy and say, hey, you're making $200,000 a year. You're a nice guy. You're a good landlord. Everybody loves you. It's a big love fest here. You're very happy with $200,000 a year. But here's, here's $20 million for your building, or whatever, whatever it works out to. Here's a really fat cash price for your building, and we want to make this money now. And so he's like, that's insane. He goes, it'll take me $20 million. Take me 100 years to make $20 million at $200,000 a year. I got to take that. So he takes it. The landlords kick everybody out. The new landlords kick everybody out. They redo all the apartments for another couple of $1 million. So now they spent $22 million, and now they rent them, and now they turn those $1,500, $2,000 a month units, whatever, into $3,500 a month units. And now there's no more cheap housing, and that's how it's happening everywhere. Wherever the math says the landlord is underpricing the market, venture capital guys are jumping in there and taking the apartments. So unless your landlord is the kind of guy who's like, no, I don't want to make any more money. I don't want cash for the building. I don't want you to buy me out. I don't want to retire. Unless they're all saying that, and in this inflationary environment, that's going to be pretty unlikely, right? Then that's what's happening. There's less and less apartments available, and the whole thing is being taken over by people who have bottom line focus. And that means forever forward, rent's going to be all about money. How much can I squeeze out of these tenants? And obviously most people who live in rented apartments are already in that situation, but there's nowhere else to go. And because there's nowhere else to go, then no one has cheap housing. Then there's no comparable cheap housing for people to even go to. And there's no choice but to pay these ridiculous prices now. And that's what's wrong with the housing market. That's what's happening. It's been completely taken over by profit motive companies. You know, and again, like I said, it's not like the other guy didn't want to make a profit, but he's happy with this paid off building that makes $200,000 a year, and he can live nicely for $200,000 a year. The guy didn't have any major aspirations aside from that. He's got a good thing. Plus, he's also got the asset of the building backing him up whenever, for his life. So he's always a happy guy. But those people aren't allowed to exist anymore. They're being taken away and replaced with profit motivated, greedy sons of bitches. And unfortunately, that's what's going on. Dan says half the world's population. Oh, wait, I'm sorry. Several apartment real estate companies drop with general market. Oh, yeah, I don't have any names off the top of my head. So basically what Mark is saying is this is a terrible situation. How do we make money off of this? And again, like everything else, though, you have to understand these companies themselves are getting lambasted by the venture capital guys who are coming in with new money. So much money, so many hundreds of billions of dollars are being thrown into this market that it's very hard for anybody to survive who's a current landlord. So even the rental companies are having a hard time. Plus, their cost of capital goes up, their basic costs go up, and they're having trouble passing along those rates because people freak out about the money. So they're effectively kicking people out by raising rents to levels that can't be afforded. And now they have an empty apartment waiting for the next people to come in who can afford that rent. And that's just as tricky as anybody who has to raise their prices. So there's a transition period there as well. So again, you can't rush it. It takes years to resolve, years. So the question is, we have to look at each one by one and say, why are they having a hard time? How are they going to resolve this issue? What's the real value? And that's a nightmare, by the way. That is a complete nightmare to do with these REITs. There's too many properties. There's too many variables. There's too many moving pieces. It's not the kind of thing I really get into. There's just a very small amount of REITs I get interested in. And it's very hard for me to get motivated to do the kind of work it takes to be sure about a new one. You cannot, it depends on their contracts and how they took out their loans and how their capital is generated and what kind of rates they're paying and how variable those rates are and when those rates are going to move up and when they have to roll over, what rate they're going to have to roll over at. It's a tight business. So it's a very tricky thing. There's certainly nothing I would say off the top of my head. It's a massive research project, but in the chat room, feel free to put up a couple of things that you might think are interesting and I'll take a look. But the kind of research you have to do to really invest in a REIT is not fun at all. So Dan says, final thing, because we got to go. Dan says half the world's population lives on $250 a day. So $250 a day is $1,000 a year. It's horrifying, but they live. It's a very weird thing. I mean, it really is. Oh, I forgot to look at Thailand. I'm interested. Thailand per capita. What do we got there? $7,000. See? And I love Thailand, and I love the people in Thailand. And we're doing this project for a hemp and marijuana project in Thailand. And I travel to the country, out in the countryside and so on and so forth out there. And they're lovely people. You say they're poor, but they're not poor because it costs about a third of everything costs about a third of what it costs here for starters. So, you know, you look at that number and they're just as well off as the people in America are. They got everything you've got. They've got all the same cars and all the same homes and the same air conditioning and things like that. They go to McDonald's just like we do. They go to stores, they go to movies, they got IMAX. You know, it's just a different scale. Everything in this country is so marked up, and we pay so much money for things. And it's a culture, though. Again, it's that culture. It's this culture of corporations taking everything over to maximize their profits, and that's why things are so expensive. Because you're not allowed to provide a value service. If you provide a value service, you're basically considered by these corporations to be a sucker, and they will stop you from doing it. They will find a way, and again, it's not evil stop you from doing it. It's somebody in accounting pops your name up on a spreadsheet and goes, hey, this guy's giving too much value for his money. I bet you we could take his whole business over and provide 20% less service for 20% more money, and people will still buy it. Let's do that. Look how much money we can make. Is it evil? Yeah, of course it's evil. It's a horrible, horrible thing to do, but they don't think of it that way. They think of it as seeing an opportunity to maximize profitability in a business. That's what we teach, though. We teach people that's okay. That's what's wrong, and it's eating us all alive. It really is. But anyway, that's all I got to say on the subject. All right, guys, have a nice day. And unfortunately, we have a whole 5-day week ahead of us next week, so that's going to be awful. But then it's July 4th, so we get another holiday. I can't believe all these holidays are weird, right? Just adding that one extra holiday makes it feel like you're constantly having 3-day weekends. Anyway, take care. I'll see you all next week. Thanks.